You have probably heard the saying, nobody ever got hurt taking a profit. Profit taking definitely feels good, but does it actually benefit your long-term performance? Or should you just let your full position run its course instead? Let's do some backtesting to find out.
In general, partial profits are more applicable to trend-following strategies. Mean reversion traders are usually spared this dilemma. Mean reversion strategies attempt to fade a temporary price extension, banking on prices to return to the average. Since the expected price move is small, traders often use tight profit targets together with wide stop losses. This is a typical distribution of profits and losses for a mean reversion strategy. Since the winning trades are small and frequent, there is little incentive to take partial profits. Trend-following strategies are different, however. Since long trends occur infrequently, these strategies rely on a small number of outsized wins to compensate for their low win rates. This is a trade distribution for a typical trend-following strategy with a 45% win rate. Locking in a large floating profit sure is tempting, but if the trend persists, you could get a few hundred more pips. Suppose you're a trend follower facing this partial profit dilemma. The best way to resolve this is to perform long-term backtests, both with and without partial profit taking. Let me illustrate this. I will backtest a simple Bollinger Bands trend following strategy that uses a standard deviation trailing stop to ride the long trends. Here is its 16-year baseline performance, without partial profit taking, using a fixed 0.1 lots per trade. We'll come back to this later. Let's add a partial profit target now. When the target is hit, I'll close half the position. The trailing stop will take care of the remaining 0.05 lots. The target should be large enough to allow you to ride the trend, whilst being small enough to capture sufficient trades. This is an example with a 100 pip partial profit target. Let's investigate how your profit-taking level affects overall strategy performance. I optimized the partial profit-taking level from 20 to 1000 pips, in steps of 10 pips. Here's how the return over maximum drawdown varies with the profit-taking level. Compared to the baseline, there is a marginal improvement in risk-adjusted performance with partial profit-taking. When looking at optimization graphs like these, always pay attention to parameter stability. You want a robust strategy that performs well over a broad range of parameters. When adding something new to a strategy, look for a general improvement, not a narrow parameter range whereby peak performance improves at the expense of stability. Look for high plateaus like the one here. Picking the parameter in the middle of this plateau is a good option. I'll select a 450 pip partial profit level, which gives a 15% improvement in return over drawdown. 10% of the original 804 trades hit this target level. There's practically no improvement at very large profit targets since very few trades accrue this much floating profit. For additional confirmation, I'll now do an equity curve comparison using Quant Analyzer. The equity curve with partial profit taking is very similar because the trade sequence is preserved. The strategy's slightly improved performance is due to the better profit retention. So taking partial profits is indeed viable, especially if you're a long-term trend follower. Note that this does not universally apply to all trend-following strategies. Partial profits usually make more sense if you hold trades for long periods, or you trade a volatile market with frequent trend reversals. Your backtest will show you the way. If you do wish to take partial profits, I suggest having one optimizable parameter at most. This would most likely be the size of your profit target. Pip or volatility-based levels are good options. Adding more optimizable parameters will increase your risk of overfitting. Be sure to subscribe and stay tuned for more tips.